Good evening. Yesterday, while I was discussing about 2008 financial crisis, I have used two terms that are CDO and CDS. Now I discuss what is the meaning of CDO and CDS. The term CDO stands for the collateral debt obligation. It is a complex financial product that is backed by a pool of loan and other assets and then sold to the institutional investors. A CDO, the collateral debt obligation, is a particular type of a derivative. Why it is called derivative? Because its value is derived from the value of underlying assets. This underlying asset served as a collateral if the loan goes into default. Similarly, other securities firm also launched CDO like auto loan, credit card loan, and education loan and aircraft leases. And the CDO remained a niche product. Niche product means this product focus on the specific market within a specific price range. And then the CDO got popularity in 2001 to 2006, but when the housing market collapsed in US, it is become the worst performing assets, which resulted in the investment bank either going bankrupt or being bailed out. The creation process of the CDO, to create CDO, it is the first the commercial bank collect the mortgage against the loan and make it a bundle, then sold to the investment bank, and the investment bank repackages it, process it, and then sold to the investors. The professionals involved in creation of CDO are securities firm, CDO managers, rating agency, financial guarantors, and investors. So this is the CDO. The credit default swap (CDS). Is the term CDS stands for the credit default swap. So it is a financial agreement between the seller and the buyer. In case of a CDS, there are two parties, one is seller and one is buyer. The buyer means the investor and the seller means the insurance company. The seller of the CDS issue or sales the CDS means one type of insurance that protect the buyers means the investors if the investment goes into the default. For this, the buyer pays some charges to the CDS seller means to the insurance company. In exchange, the buyer expects to receive a payoff if the asset goes into default. In the event of a default, the buyer of the CDS receive compensation, usually the face value of the loan. But in case of the default, the seller takes possession of the loan at its market value. And the example of the CDS is the Great Recession 2008. So at the time of a Great Recession 2008 in US, the CDS played the key roles, and it was issued by the Lehman Brothers, Bear Stearns, and AIG, American International Groups. And the second example is the European sovereign bonds. CDs were widely used during the European sovereign debt crisis, and the investors purchased the sovereign debt through sovereign bonds. After that, the investors claim and purchase the CDS to protect the capital in case the country defaults. And at that time, Portugal, Ireland, Italy, Cyprus, Spain all nearly collapsed during this time. And the advantages of CDS is a reduced risk to lenders, no underlying asset exposure. That means if you are not possess the loan instrument, you can purchase the CDS. And third one is the seller can spread risks. But the disadvantages is the CDS can give lenders a false sense of security. Second one is that it is traded over the counter, and the third one is the seller inherit substantial risks. Now, in a simple example, suppose Punjab National Bank gives loan to the investors, and this PNB collect mortgages against these loans and makes it a bundle and gives a name as complex investment option. Then the commercial bank, the PNB, sold this complex investment option to the investment bank. For example, in India, the investment bank are Credit Suisse Private Limited and PNB Paribas, the Axis Bank and the the HDFC Bank. Suppose Credit Suisse purchase the complex investment option from the commercial bank PNB and process it and make it a product and gives a name which is called as CDO. Then it is sold. This is CDO, the collateral debt obligation to the investors or publics. Then comes the role of a insurance company. If the investors predict there is a risk in their investment, then they demand insurance from the insurance company. And suppose insurance company is a United India Insurance Company, and the investors purchase the insurance from the insurance company, United India Insurance Company, and the insurance company issue the insurance against a periodical payment. Here, the insurance company is called as a seller of the CDS, and the investors called the buyer of the CDS. And the agreement between the buyer and the seller is called as swap. CDS, the credit default swap. I think you understand this, the CDO and a CDS. Thank you for watching. If any doubts, please comment and make questions. Thank you for watching. Good night.